Today, Toppy markets remain edgy on better than expected results for now. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and property news. So this is our weekly market update. Well, Wall Street closed out another week with a quiet Friday on US markets as stocks found some stability after sliding the day before. The S&P 500 edged up by less than 0.1% to 4,536 to cap its 8th winning week in the last 10. The Dow Jones Industrial Average added less than 0.1% to 35,227, and the blue chip index was lifted by gains of more than 1% each in Procter Gamble and Chevron, and it is now up over 6% in 2023 compared to the S&P 500's 18% rise. To be sure, that 18.1% jump for the S&P this year has also critics saying the rally has come too far and too fast. The risk of recession remains because inflation and interest rates remain high. The Dow playing catch-up shows there is a rotation into other sectors like healthcare and financials. The rally is not just tech-heavy anymore, said Jake Dollarhide, Chief Executive Officer at Longbow Asset Management. AutoNation slumped 12% as fears that easing car prices could hurt margins offset the automotive retailer's second quarter results that topped Wall Street estimates on both the top and bottom lines. Margin compression will continue, but won't reach the levels certainly this year, in my opinion, that we saw pre-pandemic, Mike Manley, AutoNation's Chief Executive Officer, said on an earnings call. The Nasdaq Composite slid 0.2% to 14,032, a day after tumbling to its worst loss in more than 4 months. Nvidia and Meta Platforms lost more than 2% each in a choppy trading session, while the S&P 500 utility sector jumped 1.5%, followed by a 1% rise in the healthcare sector. Netflix dipped 2.3%, down for a second straight day after the video streaming company's quarterly results this week failed to impress. Analysts attributed Friday's volatile trading to the expiration of monthly options and the expected special rebalancing of the multi-trillion-dollar Nasdaq 100 following the close of trading. The top stocks have become so big and their movements have become so influential over the market that Nasdaq is rebalancing its Nasdaq 100 index before trading begins on Monday to lessen the impact that some stocks have had on the overall index. The 7 stocks, which also include Amazon, Apple and Nvidia, are collectively trading with stock prices that are 44 times higher than their earnings per share over the past 12 months, according to equity strategists at Bank of America. That's an expensive level compared with history, but the other stocks in the S&P 500 are trading at a more reasonable-looking 17 times earnings. The stock market's gain have broadened out a bit recently. The earnings report season is gaining momentum, and the majority of companies are reporting better results than expected. They're doing so by a bit less than usual, though, according to FactSet. Now, the stock market has generally been up this year as the economy has defied predictions of a recession. It's so far powered through much higher interest rates, and of course that was meant to bring down inflation, and some say that it may outlast the Federal Reserve's rate hike campaign. The Fed is widely expected to raise its federal funds rate on Wednesday to its highest level since 2001, but the hope is that that could be the final increase of the cycle because inflation has been cooling since last summer. The federal funds rate started last year at virtually zero. When Fed Chair Jerome Powell speaks on Wednesday after the central bank's decision on rates, economist at Deutsche Bank says he's likely to emphasize that further evidence is needed to have confidence that inflation will be tamed. Beside the Fed meeting, next week will also feature earnings reports from 3 of the magnificent 7 companies behind the majority of the S&P 500's gains this year. Alphabet, Meta Platforms and Microsoft will report their earnings, and expectations are high after they soared more than 35% so far this year. Another one of the 7, Tesla, though, slumped sharply on Thursday despite reporting stronger profit and revenue than expected on fears about upcoming growth. It helped drag the S&P 500 to a loss and the Nasdaq Composite to a drop of 2.1%. On the losing side of Wall Street was American Express, which fell 3.9%. It reported stronger profit for the spring than expected, but its revenue fell short of forecasts. Roper Technologies rallied 3.7% for one of the larger gains in the S&P 500 after it reported better profit and revenue for the spring than analysts expected. The company, which looks to dominate niche tech markets, also raised its financial forecast for the full year. Comerica swung from an initial gain to a loss of 4.1% after reporting stronger profit and revenue for the spring than analysts expected. The regional bank also reported a decline in average customer deposits, though it said the level stabilised in the second half of the quarter. Deposits have been under heavy pressure since several banks failed in March after customers suddenly yanked out their cash. In the bond market, Treasury yields were mixed. The 10-year Treasury fell to 3.844% from 3.86% late on Thursday. It helped set rates for mortgages and other important loans. The 2-year Treasury yield, which moves more on expectations for the Fed, ticked up to 4.846% from 4.84%. Still, of course, in recession inversion territory. European stock markets traded on a mixed fashion on Friday as investors digested more corporate earnings as well as stronger than expected UK retail sales. The DAX index in Germany traded 0.17% lower. The FTSE in London traded up 0.23% and the CAC 40 in France rose 0.65%. UK retail sales rose more than expected. In fact, the retail sales data for June did actually grow by 0.7% on the month compared to an expected 0.2%. This still represents an annual drop, though, of 1%, but better than the 1.5% that was predicted. Retail sales grew strongly, with food sales bouncing back after the effects of the extra bank holiday, partly helped by good weather, and department stores and furniture shops also having a good, strong month, ONS chief economist Grant Fitzner said. However, this followed the release late on Thursday of the July GfK Consumer Confidence Gauge, which fell for the first time in 6 months, suggesting the reality of soaring inflation is indeed starting to hit the UK consumer. This could weigh heavily on economic growth as the year progresses, as the Bank of England is widely expected to continue its rate hiking campaign next month, given inflation remains well above target, even after slowing more than expected in June. That said, the slight downturn in inflation, as reported this week, created a response in the UK more in line with a great military victory. The results showing headline inflation dropped sharply to 7.9% in June from 8.7% the previous month. That was better than expected and did mark the first positive surprise on UK inflation in 2 years, but they're still worse than in the Eurozone. And the fall in core inflation, excluding fuel and food, was only 0.2 percentage points, so don't get overexcited. The Bank of England has a nastier inflation problem to deal with than most of its counterparts, but it also has a weaker economy, which would make it harder to tighten rates aggressively. Thus, the notion that the bank might have a terminal rate that tops close to a percentage point higher than in the US, and even more than 2 percentage points above the projected terminal rate for the European Central Bank, does look a little overdone. The euro area economy avoided a winter recession after all, with revised data showing it stagnated at the start of the year instead of shrinking as previously thought. Output in the 20-nation currency bloc was flat in the first quarter, according to the latest figures from Eurostat. That's up from a prior reading of minus 0.1%, which combined with a decline of the same magnitude at the end of 2022 had suggested the first 6-month contraction since the COVID-19 pandemic. Whether the euro area contracted during the winter or not, the outlook remains one of lingering weakness, said Jamie Rush, chief European economist for Bloomberg. As the impact of the energy shock passes, it is giving way to a squeeze from tight monetary policy. That'll keep growth slow for the rest of the year. Manufacturing proved to be one of the biggest drags on growth, and inflation is also weighing on the region, although it was almost halved since its 10.6% peak in October. And the European Central Bank is set to hike rates again next week. President Christine Lagarde will seek to snuff out talk of borrowing costs being reduced anytime soon when she speaks following the July 27th policy announcement. The onus is on rates staying restrictive for longer, particularly after data this week saw underlying inflation for June revised higher. Euro area consumer confidence increased more than expected in July, an encouraging sign for the 20-nation currency bloc. The reading of minus 15.1 after minus 16.1 in June compares with an economist estimate of just minus 15.8. The European Commission said improvements show that the gauge is slowly but steadily recovering towards its long-term average. The quarterly earnings season continued on Friday, with Glencore falling 0.9% despite the mining giant announcing that it now expects profits at its trading division this year of up to $4 billion, exceeding its long-term annual guidance. As impressive as it is, it would still be below the record $6.4 billion reported in 2022. Thales stock fell 3.4% after the French aerospace company narrowed its sales growth guidance after a solid first half. And Swedish steelmaker SSAB stocks slumped 12% after reporting a bigger than expected drop in quarterly earnings, while Lonza dropped 7% after the Swiss drug manufacturer cut its full-year outlook. Commodities are starting to post some diverging trends as US soft landing hopes improve. Oil has benefited from a resilient US economy, but gold has struggled as a tight labour market suggests the Fed may need to keep interest rates high for longer. Oil prices are rising on optimism that the outlook for China and India should keep the global crude demand outlook intact, while OPEC Plus will make sure that the market remains tight. The UAE energy minister noted actions by OPEC Plus to support the oil market were sufficient for now, but that the group is only a phone call away if further steps are needed. WTI crude has been rising since the end of June, but has clearly found resistance around the $77 level. Next week, energy traders will have to pay attention to global flash PMI readings, a handful of major energy companies' earnings, the standard weekly stockpile data points, and some energy conferences, which could provide some insight for the future shifts with supply and demand. Crude prices rose on Friday, closing a volatile week with gains on rising hopes that China, the world's largest crude importer, will roll out more stimulus measures to support its stuttering economic recovery. The country revealed disappointing second quarter growth numbers earlier this week, prompting Beijing to unveil new measures on Friday aimed at promoting local spending and rising expectations of more widespread support. That said, caution ahead of next week's Fed meeting has stymied any major gains, especially as the dollar rebounded from a 15-month low and positioning for the meeting. The US crude futures traded 1.56% higher at $76.81 a barrel, while the Brent contract climbed 1.57% to $80.74. Both contracts saw gains of more than 1% this week. But gold futures fell 0.36% to $1,963 an ounce, while the euro-US dollar traded roughly unchanged at 1.1125. Most Asian stock markets moved on a flat to low range on Friday as investors weighed more Chinese stimulus measures against weaknesses in technology stocks after chip-making giant TSMC presented a bleak outlook for the year. On Monday, China's GDP grew at a slower than expected pace of 6.3% in the second quarter from a year earlier. That was weaker than the median forecast of 7.1% by economists, and Beijing has set a moderate GDP growth target of about 5% for 2023. China's top economic planner, the National Development and Reform Commission, unveiled new measures aimed at boosting spending in the automobile and consumer electronics sector. The move comes amid promises of more policy support from Beijing after data showed that a Chinese economic recovery slowed sharply in the second quarter. Chinese stocks recouped some weekly losses on stimulus cheers on Friday, with Hong Kong's Hang Seng, the best performer in Asia, rising 0.8%. But the Shanghai Composite Index traded sideways after relinquishing most early gains and lost around 1% this week, having trimmed some weekly losses on Friday. Fund managers were seen growing less optimistic over a Chinese economic recovery this year amid weak economic indicators and limited policy support. Bank of America economists warned that the local stocks could test 11-year lows as a post-COVID economic rebound runs out of steam. Weaknesses in China bode poorly for broader Asian markets, many of which depend on the country as a trading hub. Broader Asian stocks were held back by weaknesses in heavyweight technology shares. The Taiwan Semiconductor Manufacturing Co., Asia's most valuable company, sank 3% on Friday after the firm reported a 23% drop in its second quarter profit, but also warned that its sales and profits were set to decline further this year. The Taiwanese chipmaker warned of a 10% drop in sales on Thursday as a weaker global economy is expected to weigh on chip demand. TSMC was not alone in presenting a weak outlook. Hong Kong's Sunny Optical Technology Group, which manufactures smartphone components for several major brands, fell 1% after it flagged as much as a 70% profit decline in the first half of 2023. Most tech-heavy Asian exchanges were mixed, with South Korea's Kospi up 0.37%, while the Taiwanese weighted index slid 0.7%. Japan's Nikkei 225 fell 0.46%, while the broader Topics was down a tad as data showed that Japanese consumer inflation remained sticky through June, a trend that could attract policy tightening by the Bank of Japan. On the other hand, Indian stocks continue to outperform this week, with the Nifty 50 index notching record highs for the past 4 sessions. Now in Australia, the mood continues to darken. A sell-off across the US technology sector and downgrades by Taiwanese chip-making giant TSMC spilled over to the Australian share market on Friday amid disappointing results from Wall Street's tech giants and speculation of further tightening by the Federal Reserve. The local technology sector subsequently dropped 2.7% on Friday, with Xero tumbling 3.9% to $122.20. Technology One fell 2.9% to $15.33, and Life360 declined 2.9% to $7.62. The S&P ASX 200 dropped 0.15%, and that took it to 7,313 on Friday, but the benchmark posted a very modest advance of 0.1% for the week. Shares remain at risk of a short-term correction given high recession risks, worries about Chinese growth, the risks of more rate hikes with central banks, including the RBA, remaining wary, and the seasonally rougher patch often seen through August to October, said AMP's head of investment strategy Shane Oliver. Gold miners were among the biggest laggards as a strong US dollar weighed on the price of the precious metal, and Bellevue Gold tumbled 3.6% to $1.47, and Perseus Mining fell 4.4% to $1.72. Newcrest declined 5.3% to $26.19 after takeover bidder Newmont reported quarterly earnings that missed analyst estimates, causing its share price to drop by 6% in New York, its biggest daily decline in 12 months. A cautious outlook for iron ore and concerns about the generosity of BHP and Rio Tinto's future returns to shareholders has led broker UBS to double down on its sell rating on the ASX mining giants. It comes as both iron ore producers this week provided mixed updates for the June quarter shipments. Singapore iron ore futures were lower in afternoon trading on Friday. Iron ore contracts on the Singapore exchange dropped 0.3% to $113.11 a tonne. BHP revealed on Thursday weaker production guidance for the 24 financial year than many analysts were expecting, dimming the outlook for its most important division. It also sold less Australian iron ore in the past 3 months than brokers had forecast. UBS lowered its 12-month price target on BHP to $37 a share from $44.62. And analyst Lachlan Shaw said the latest results were strong, but that the company's higher-than-predicted net debt and increased expenditure was a risk to dividends. The broker said at spot prices, BHP's free cash flow yield was about 6%, which fell to about 4% at $90 a tonne iron ore price. Chinese demand for the steelmaking commodity is softening, mainly due to worsening conditions within its property sector, and strategists are anticipating that Chinese policymakers will respond with stimulus measures to boost economic activity. UBS downgraded its iron ore forecast by 13.8% to $100 US a tonne from $116 a tonne for the 2024 financial year. And Commonwealth Bank analyst Vivek Dhar said that there might be limited impact from any policy support measures announced in coming weeks, referring to China. Our major concern remains China's property sector, where conditions are clearly worsening, he said. We believe confidence among home buyers will take time to stabilise. And UBS also has a sell rating on rival Rio Tinto, lowering its price target to $95 a share from $116. The broker flagged a potentially lower dividend due to the miners' increased capex in the medium term. It estimates a payout ratio of 50% in the first half and 60% in the full year. The valuation of the stock was reinforced by Rio's downbeat macroeconomic comments, and we believe risk rewards is skewed to the downside, they said. Rio Tinto reported on Wednesday that its iron ore division had achieved its most productive first half in 5 years and would deliver the top end of its guidance range. Rio's first half profit is due on Wednesday after the closing bell. Production for the full year is set to be in the upper end of a range of 320 to 335 million tonnes. The upbeat pledge was made despite a train derailment, which ensured Rio's iron ore exports over the past 3 months were relatively soft and weaker than the same time last year at 79.1 million tonnes. Liberum Capital's head of commodity strategy, Tom Price, has predicted that iron ore will move below $100 a tonne, predicated on China's steel production cap, new low-cost supplies from southeastern Guinea, and critically peak steel intensity. Elsewhere, Treasurer Jim Chalmers has split with the Reserve Bank over concerns that extremely low unemployment is fueling inflation, labelling the central bank's full employment estimate, quote, a technical assumption. The Australian Council of Trades Unions is pushing Labor to redefine full employment as zero involuntary unemployment in the federal government's updated statement on the conduct of monetary policy, due to be signed with the RBA later this year. The change, if adopted, would alter the RBA's approach to monetary policy making, given that the Bank and Treasury use the non-accelerating inflation rate of unemployment, the NYRU, as their main gauge for full employment. The RBA estimates that the NYRU, which is the unemployment rate at which inflation is neither rising or falling, to be in the low fours, meaning the central bank views the current 3.5% unemployment rate as unsustainably low. Treasury puts the NYRU at 4.25%. Asked on Friday whether he agreed with the union movement that the RBA's use of the NYRU was morally indefensible, Dr. Chalmers said it was a technical assumption that should not be viewed as the government's aspiration. Whether it's the Reserve Bank or the Treasury forecast, they rely on a technical assumption that's different from an objective or an aspiration. The government's objective and aspiration is to create good, secure, well-paid jobs, Chalmers said. On Thursday, the latest labour force survey showed unemployment held steady at 3.5% in June, despite 12 interest rate rises since May last year. AMP chief economist Shane Oliver said the union movement's proposed definition of full employment made no sense, asking the RBA to also push structural and frictional unemployment to zero, consistent with some concept of zero involuntary unemployment, will likely make it impossible to meet its 2 to 3% inflation objective and run a high risk of permanently high inflation, Mr. Oliver said. Rather, it should be the goal of the government to find ways to reduce structural and frictional unemployment by improving education and training standards, minimising skills mismatches, making it easier for workers to retrain, increasing labour mobility, and increasing labour market flexibility. The union movement was fiercely critical of a speech last month by RBA Deputy Governor Michelle Bullock, in which she said the jobless rate needed to climb to around 4.5% to tame inflation. Dr. Chalmers announced last week that Ms. Bullock would succeed Dr. Lowe as RBA Governor when his term expires on September the 17th. Markets are fully pricing in another interest rate rise in her first board meeting in October, with the estimated probability of a rate rise in August also increasing to 62% after June's stronger than expected employment figures. Economists say that the June quarter consumer price index due out on Wednesday will be pivotal for determining whether the RBA increases the cash rate to 4.35% at its August 1 board meeting from 4.1%. The central bank's May forecast shows it expects headline inflation to fall to 6.3% in June from 7% in March. ANZ senior economist Adelaide Timbrell said she expects inflation to fall to 6.2%, just below the RBA's forecast, and giving the bank reason to keep rates on hold for the foreseeable future. A potential acceleration in services inflation to a two-decade high of 6.2% is expected to be more than offset by a sharp decline in goods price inflation, which has eased on the back of a normalisation in supply chains and lower consumer demand. However, housing was likely to be the main driver of inflation in the quarter, Ms. Trimble said, with rents tipped to have increased by 2.1% in the quarter amid a shortage of properties. Westpac senior economist Justin Smirk said he expected headline inflation to fall to 6.3%, while underlying inflation was expected to fall to 6% from 6.6%. Overall, the June quarter CPI is set to confirm that inflationary pressures peaked in late 2022 and continues to moderate as we move into 2023. However, it will also continue to highlight that core inflation remains significantly above the top of the RBA's target band and is not likely to return to being within the band any time soon. The RBA does not expect inflation to return to the upper limit of its 2 to 3% band until mid-2025. And ASX company profits are on track to contract in the 2024 financial year for the first time since the pandemic, casting a dim light on the forthcoming earnings season, which investors and strategists warn will translate to weaker returns for shares. Soaring wages bills, the rising cost of borrowing and high energy costs are eroding profit margins and offsetting the bullish performance of Australia's job market and robust house price growth. There are anecdotes. The consumer has retreated after the last 2 rate hikes since May in terms of cash flow, and psychologically it's starting to hit, said Richard Shellback. Australia's jobless rate of 3.5%, which was revealed on Thursday, was boosted by a record low New South Wales unemployment rate of 2.9%. A higher than expected June quarter consumer price index due on July 26th could sway the Reserve Bank to increase the cash rate to 4.35% next month. And the reporting season, which unofficially begins with Rio Tinto's first half on Wednesday, is tipped to extend a pattern of companies downgrading earnings guidance as consumers cut discretionary spending to counter rocketing rents, mortgage servicing costs, and the weekly shop. The trend of margin squeeze we expect to continue, said Luke McMillan, head of research at OFA Asset Management. This is slowing top-line revenue growth, coming up against robust wages growth and increasing debt costs, though we think it'll be more a squeeze than a crunch in this reporting season. UBS equity strategist Richard Shellback said investors are right to be concerned about the risk of further downgrades in August after a downbeat confession season. It's more about how the financial year 24 numbers evolve. I think we'll continue to see downgrades, he said. That's already been in motion for a few months and will continue through results, and analysts will more likely or not revise their earnings forecast down. Consensus forecasts now call for earnings per share amongst S&P ASX 200 members to post a median fall of 3.1% in the financial year 2024, as the energy and mining sectors post significant declines from cyclical peaks in the financial year just ruled off. A broad cross-section of retailers and pandemic-era winners have already downgraded expectations, including Harvey Norman, Adairs, Baby Bunting, Universal Stores, Best and Less, and Candlestop Dusk. Mr. Shellback said the strong jobs market is only a small buffer against brewing economic headwinds. It's a fact that the labour market is still strong, but it's supporting, not boosting the market, he said. The bearish prophecies of a housing and consumer collapse haven't played out at all. And what's holding the retail spending numbers above water is the fact everybody has jobs. We're looking for evidence the consumer has cut spending over the past few months. There are anecdotes the consumer has retreated after the last 2 rate hikes since May in terms of cash flow, and psychologically it's starting to hit. The Australian share market's weighting towards cyclical mining and energy businesses means its EPS performance is expected to underperform other advanced markets in the financial year 2024, with the global MSCI All World Development Index tipped to grow 10.9% and the global MSCI All World Emerging Index 9.8%. Australia's energy sector, which includes Woodside and Santos alongside premium thermal coal miners Whitehaven and New Hope, is expected to see EPS slump 35.1% on average, and energy and coal prices have slumped from 2022 highs associated with Russia's war in Ukraine and the uprooting of energy supplies in Europe. So if we strip energy and materials out, most other sectors are still growing, he said, and you see consumer discretionary earnings are still growing at around 4%. According to analyst consensus, the S&P ASX 200 sectors expected to deliver the strongest EPS growth in financial year 2024 are technology at 30.5%, healthcare at 29.2%, and communication services at 25.8%. And last week, Macquarie said EPS expectations for the financial year 2024 fell by 4% over the past 3 months, as the lagged impact of 12 cash rate increases since May 2022 flows through to consumer behaviour. The RBA cash rate, of course, is 4.1% currently. I think this earnings season is going to be pretty tough, said Jeff Wilson, the chairman of Wilson Asset Management. I'd say the economy looks like it's hit a wall in the last couple of months with the impact of interest rates. The real economy is feeling it. I think things will get worse. Fund managers will scour profit margins, balance sheets and outlook statements for indications as how they're navigating interest rate settings at their highest level since April 2012. And Mr. Wilson added investors should brace for a difficult 6 months as he believes the economy will deteriorate further between now and Christmas. This reporting period, there'll be a lot of uncertainty, so management won't be able to confidently predict the outlook, he said. Really, you want companies that can maintain their margin in a difficult environment. The reported results might be reasonable as the economy only really started to grind to a halt the last couple of months. But remember, if interest rates go higher, it's going to have even more of a negative impact on economic activity. And finally, the Aussie dollar was at 67.26 against the US dollar, while Bitcoin continued to wander around 30,000 US dollars in that narrow range we've seen in recent weeks. So standing back, 3 quick points. Firstly, in Australia, the economy is going to weaken ahead, not least because of the changed environment and the demand from China, and also the higher interest rates beginning to bite. Secondly, in the US, there's an expectation of a soft landing beginning to come back to the fore again, but we'll see what the Fed says about that next week. And thirdly, and more broadly, if you look at the European sector, including the Eurozone and the UK, well, there are big economic issues there. And of course, in Australia and in the US, as well as the UK, there are significant questions about where we are headed. And whilst there is a lot of expectation in the markets that rates are going to get cut and cut quick, I think everything I'm seeing suggests that rates are going to stay high for quite a long period of time. Worth remembering, of course, the RBA is not expecting to see inflation within band until 2025. So what do you take away from this is that Australia is particularly exposed to the pressures of higher rates and economic shocks. And I expect to see that flow through into weaker output, weaker consumer confidence, and higher levels of financial pressure on households, as we've been reporting. So this is going to be a long, slow grind, and I suspect that the equity markets are considerably overvalued just now. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.